Every empire in history ran on the same formula: armies, navies, land seized by force, resources taken at gunpoint. But in 1999, one country found something more powerful than all of that combined. A financial mechanism so quiet, so deeply woven into the fabric of the global economy, that 25 years later, the entire world cannot afford for it to stop working. No invasion, no declaration of war, no treaty signed under duress, just interest rates. And right now, in March 2026, that mechanism is beginning to fracture. What happens next will determine the financial fate of hundreds of millions of people. People who have never once thought about Japan. 3 days ago, 9 Japanese bureaucrats sat in a quiet room and made a decision. A decision that controls whether your retirement account goes up or down this year. You didn't vote for them. You've never heard their names. But when one of them broke ranks, demanding an immediate rate hike, global currency markets shifted within minutes. Not because of the Federal Reserve, not because of Wall Street, because of Tokyo. Most people spend their entire investing lives watching the wrong city. The real center of gravity in global finance isn't Washington. It isn't New York. It's a central bank building in Japan. And what gets decided there over the next 12 months will shape your mortgage rate, your savings, and the direction of the world economy, more directly than any decision made anywhere else on Earth. Here's why, and here's the data that proves it. Let's begin with the mechanism itself. Because once you understand it, everything else becomes obvious. For more than 2 decades, Japan held its interest rates at essentially zero. The cheapest borrowing environment in the history of modern finance. Foreign investors caught on fast. They borrowed unlimited yen at near zero cost, converted it into dollars, and deployed that capital into higher-yielding American assets. The profit was simple. It was the spread between what they borrowed at and what they earned. For all practical purposes, it was free money, and the world took as much as it could carry. Today, in early 2026, a US-based hedge fund can borrow the equivalent of money, $100 million in yen at just 0.75% for a single month, convert it to dollars, and park it in American assets returning 5, 6, or 7% annually. The math still works, barely, because despite Japan's recent rate increases, the yen has kept weakening against the dollar, which keeps the trade alive by absorbing the higher borrowing costs. But the margin of safety is collapsing, fast, and the scale of what's sitting on top of that collapsing margin is almost beyond comprehension. The outstanding value of yen forward contracts held by global hedge funds and principal trading firms alone reached money, 35 trillion yen as of late 2025. When you factor in the full universe of forwards, FX swaps, and currency swaps, the total value of positions dependent on the yen carry trade hits money, 281 trillion yen. That is the scale of global investment resting entirely on Japan keeping borrowing cheap. When the Bank of Japan moves its rate by even a fraction of a percent, trillions in leveraged positions around the world are forced to react simultaneously. Once the yen starts appreciating meaningfully, the reversal won't be gradual. It will be violent. Precisely because the trade has grown so enormous. This is not a theoretical risk. This is not something analysts are warning might happen someday. It is happening right now, in real time, and the data from this quarter makes that unmistakably clear. In the first quarter of 2026, the yen carry trade can be described in one word: fragile. We are not watching a total collapse, not yet. But we are witnessing a controlled unwind, with major hedge funds already quietly deleveraging their yen positions. The Bank of Japan has pushed its short-term policy rate toward 1.0%, which still sounds modest by global standards, but represents the highest borrowing cost in Japan in nearly 20 years. For every player in this trade, every fraction of a percent increase in Tokyo shrinks the safety margin they built their entire position on, the assumption that borrowing would remain nearly free forever, and the link to global equity markets is now mathematically undeniable. In 2026, the correlation between a strengthening yen and a falling stock market has tightened to a degree that can no longer be dismissed as coincidence. The USD to JPY exchange rate has become as important a leading indicator for investors as the Federal Reserve's own policy statements. Think carefully about what that means. An exchange rate between two currencies, one of them not even American, now predicts U.S. stock market moves more reliably than the central bank that controls American monetary policy. That is how deeply Japan's financial influence has penetrated the global system. Major research houses have labeled the carry trade a ticking time bomb, warning it is vulnerable to a massive unwind similar to the collapses seen in 2008, 2015, and 2020. The difference this time is scale. In those prior episodes, the trade was a fraction of what it is today. The bomb is bigger, the fuse is shorter, and the alarm bells that started ringing in January have only gotten louder since. In early January 2026, Japan's benchmark 10-year government bond yield briefly touched its highest level since 1999. That was January. By March 23, 2026, things have moved further still. Japan's 10-year bond yield has climbed above 2.3%, marching toward multi-decade highs, as the ongoing conflict in the Middle East and surging oil prices pile new inflationary pressure onto the system. The longer end of the curve tells an even more dramatic story. Japan's 30-year bond yield now sits at 3.53%, up nearly a full percentage point from just 1 year ago. The 40-year bond yields 3.55%. For a country that spent an entire generation at zero, these numbers represent a seismic structural shift in the global interest rate environment. And they matter for one brutal reason: what rising yields cost Japan's own government. Servicing Japan's national debt rose more than 10% in the fiscal 2026 budget, surpassing money, 31 trillion yen for the first time in history, the sixth consecutive record high. Total outstanding government bonds are projected to reach money, 1.15 quadrillion yen by the end of this fiscal year. Japan carries a debt-to-GDP ratio of 237%, the most indebted developed nation on Earth, second only to Sudan among all countries globally. And that ratio only climbs higher as borrowing costs rise on a debt pile of this magnitude. Raise rates to fight inflation, and the interest bill explodes. Keep rates low to manage the debt, and inflation keeps burning, and the currency keeps weakening. Japan is caught between two catastrophes, and every policy decision it makes sends shockwaves through global markets the moment it is announced. Now add the lever that gives Japan direct influence over the United States government itself. As of January 2026, Japan holds money, $1.225 trillion in U.S. Treasury bonds, making it the single largest foreign creditor of the United States, ahead of China, ahead of every other nation on Earth. American taxpayers write billions in annual interest checks to Japanese institutions, but the real power isn't the interest. The real power is what happens when Japan's own bond market starts offering better returns than American treasuries. Right now, 10-year Japanese government bonds offer higher yields than currency-hedged 10-year U.S. Treasury bonds. When Japanese bonds pay more than hedged American debt, Japanese pension funds, insurance companies, and banks managing trillions in savings stop buying American debt and bring that capital home. The repatriation of Japanese capital from foreign markets back to Japan is a scenario widely predicted by analysts for 2026. Even modest rebalancing flows can move U.S. Treasury yields meaningfully, particularly when global positioning is crowded and volatility is elevated. It is the marginal seller that drives price in bond markets, not the average. And when Treasury yields rise, mortgage rates rise, car loan rates rise, business borrowing costs rise, the entire American credit market reprices upward. Not because the Federal Reserve made a single decision, because Tokyo did. A steeper yield curve in Japan forces European and American curves to follow. It is an interconnection that most retail investors have no awareness of, and that most professional investors are still underestimating. Into all of this steps a new political force the financial world is still calibrating. Prime Minister Sonai Takai won Japan's elections on February 8, 2026, with a commanding two-thirds majority in the lower house. Her mandate, massive government investment in technology, semiconductors, and defense, against the backdrop of a regional security environment made volatile by the war in Iran. Her government is spending at a pace Japan has never seen before. The fiscal 2026 budget of money, 122.3 trillion yen, is the first to exceed 120 trillion yen, a record high for the second consecutive year. Defense spending alone reached money, 9 trillion yen, hitting the 2% of GDP target 2 full years ahead of schedule. More spending means more bond issuance. More bond issuance means more upward pressure on yields. More upward pressure on yields means a faster acceleration of the exact carry trade unwind the world is trying to manage carefully and quietly. But here is where the political collision becomes truly dangerous for global markets. Takai needs cheap borrowing to fund her record spending agenda. That puts her in direct conflict with the Bank of Japan's inflation-fighting mandate. After her landslide victory in February, she made clear to the BOJ governor her reluctance to see interest rates rise further. You now have a prime minister demanding low rates to finance historic government spending, on one side. A central bank signaling continued policy normalization, on the other. And a money, 281 trillion yen derivatives market watching every word spoken between them, ready to move violently the moment the messaging becomes contradictory or confused. Then there is the variable nobody planned for. The one rewriting Japan's entire financial calculation in real time. Japan imports approximately 95% of its energy from the Middle East. The ongoing conflict involving Iran has driven oil prices sharply higher. Higher oil prices mean higher import costs for Japan. Higher import costs mean higher inflation. Higher inflation means more pressure on the Bank of Japan to raise rates faster than it otherwise would. Faster rate hikes mean an accelerated carry trade unwind. A war in the Middle East is now a direct input into global financial stability, and the transmission mechanism runs entirely through Tokyo. The BOJ itself warned in its most recent statement that inflation faces renewed upward pressure from rising crude oil prices, and that its hands are tied in ways no other major central bank faces. Prime Minister Takai is simultaneously managing a diplomatic tightrope with the United States, meeting President Trump to discuss economic and military cooperation, after he initially urged Japan to deploy warships to the Strait of Hormuz before walking that demand back. Japan is being pulled in every direction at once, by inflation, by energy vulnerability, by a record spending agenda, by a central bank trying to exit decades of emergency policy, and by an American president making military demands it cannot easily refuse. All of it is connected, and all of it flows directly into whether your savings are worth more or less 12 months from now. Here is what the data says about the timeline ahead. The Bank of Japan held its key rate at 0.75% at its March 19, 2026 meeting, the highest level since September 1995, in an 8-to-1 decision, with one board member dissenting for the second consecutive meeting in favor of an immediate hike to 1%. That sustained dissent is an institutional signal. The next move higher is not a question of whether, only when. Most Japanese economists expect the next hike in October 2026, but a weaker yen accelerating import-driven inflation could pull that forward to the second quarter of this year. Major Wall Street banks are forecasting the next hike by June, followed by a path that takes Japan's policy rate to 1.5% by the end of 2027. The IMF has stated plainly that Japan is appropriately withdrawing monetary accommodation, and that rates should continue moving toward neutral. The direction is clear. The pace is the only variable still in debate. The scenario everyone is hoping for is slow and orderly. If Japan can normalize rates gradually, with clear communication and no sudden shocks, the carry trade can unwind in a way global markets can absorb. But sudden shocks to the yen, an unexpected rate decision, An oil price spike, a political statement that rattles currency traders, can trigger a swift reversal that hammers stock and bond markets worldwide simultaneously. In August 2024, the BOJ raised rates unexpectedly. The Nikkei fell over 12% in a single session. The S&P 500 corrected 6% in the days that followed. That was a warning shot. The carry trade was smaller then. The positions are larger now. The consequences of a disorderly unwind in 2026 would be proportionally greater. The three numbers you need to monitor from this moment forward are these. USD/JPY, currently trading between 147 and 149, with late 2026 forecasts clustering around 144 to 148 as the interest rate differential between the two countries continues to compress. A move below 145 signals carry trade stress. A sustained break below 140 signals crisis conditions. Japan's 10-year government bond yield, currently at 2.26% and rising. A break above 2.5% triggers repricing in bond markets globally. Bank of Japan meeting dates, April 27th and 28th is next. June is increasingly live for the next rate move based on current inflation data. Japan does not need aircraft carriers. It does not need nuclear weapons. It holds money, $1.225 trillion of U.S. government debt. Money, $12 trillion in global foreign assets. And money, 281 trillion yen in yen derivative positions that the entire world is sitting on top of, without fully realizing it. The yen carry trade has been the fuel of the global bull market for a generation. When it unwinds, and it is already unwinding, it creates a liquidity vacuum in New York, London, and Hong Kong simultaneously. The only question that matters for your money right now is whether the 9 people in that Tokyo boardroom, fighting inflation, a record debt load, a geopolitical energy crisis, and a prime minister who wants cheap money indefinitely, can make this transition orderly. Because if they cannot, the next shock doesn't stay in Japan. It doesn't stay in Asia. It doesn't stay in the bond market. It arrives everywhere at once.